If you own gold or silver right now, then you need to pay close attention to what happens next, because the next trading session could reveal whether this precious metals rally is ready for another major move, or whether investors are about to face a sharp pullback. Gold and silver have already shown incredible strength in 2026. Yet the biggest story may not be the price you see on the screen. The real story is what is happening underneath the market. Today, gold is trading around the upper $4,000 area, while silver is holding around the mid-$60 area. Recent market action has shown that both metals remain highly sensitive to the US dollar and bond yields. Mint. That means the next move may depend less on yesterday's headlines and more on what traders believe the Federal Reserve will do next. So if you own physical gold or silver, then stay with me, because we are going to break down the signals that matter most before tomorrow's trading session. The first thing you need to understand is that precious metals are not moving in isolation. Gold is reacting to interest rates. Gold is reacting to inflation. Gold is reacting to the US dollar. Gold is reacting to geopolitical risk, and silver is reacting to all of those forces while also responding to industrial demand. That makes silver especially interesting. When investors become worried about the economy, gold can benefit from safe haven demand. When investors expect easier monetary policy, gold can benefit from falling real yields. When industrial demand becomes stronger, silver can benefit from another powerful source of demand. This is why silver can sometimes move much faster than gold. But that strength also comes with greater volatility. Silver can rise aggressively. Silver can also fall aggressively. That is why the next session matters. The market is currently trying to understand whether the recent strength is simply another rally inside a long-term bull market or the beginning of a much larger move. And that question becomes even more important because the Federal Reserve is still facing a difficult situation. The latest Federal Reserve decision kept the federal funds target range at 3.50% to 3.75%. The Fed also said inflation remains elevated relative to its 2% goal. Federal Reserve. That is extremely important for gold investors. Gold does not pay interest. Silver does not pay interest. So when interest rates stay high, investors have a stronger reason to hold cash or government bonds. But when expectations shift toward lower rates, the opportunity cost of holding precious metals can fall. That can create a powerful tailwind. The problem is that inflation has not disappeared. The Federal Reserve has acknowledged that inflation remains above its target. It has also pointed to supply shocks and energy prices as important factors. This creates a difficult balance. If the Fed cuts rates too quickly, then inflation could remain a problem. If the Fed keeps rates high for too long, then economic growth could weaken. Either scenario can create opportunities for precious metals. That is why you should not focus on one headline. You need to watch the entire system. Look at the dollar. Look at Treasury yields. Look at inflation expectations. Look at employment data. Look at Federal Reserve communication. Then look at gold and silver. That is where the real signal begins to appear. The US dollar is especially important. Gold is priced in dollars. Silver is priced in dollars. When the dollar strengthens, it can create pressure on precious metals because metals become more expensive for buyers using other currencies. When the dollar weakens, the opposite can happen. But there is another layer. Investors do not only care about the level of interest rates. They care about real interest rates. They care about what they earn after inflation. If inflation remains elevated while interest rates fall, then real yields can decline. That can become bullish for gold, and silver can benefit as well. This is one reason why the latest inflation data matters so much. The Bureau of Labor Statistics released the July Consumer Price Index on August 12th. The market has been watching inflation closely because the Federal Reserve is still trying to bring inflation back toward its 2% objective. Bureau of Labor Statistics. The important point is not simply whether inflation goes up or down in 1 month. The important question is whether the broader trend is moving toward sustainable price stability. That is what the Fed needs to see, and that is what precious metals investors need to watch. Because if inflation stays stubborn, then gold can continue to attract investors who want protection against declining purchasing power. But if inflation falls rapidly while economic growth stays strong, then yields could remain attractive. That could create a more difficult environment for gold. Silver is even more complicated. Silver has a monetary side. Silver also has an industrial side. This dual role is one of the reasons the silver market can become extremely powerful during periods of supply stress. Silver is used in electronics. Silver is used in electrical applications. Silver is important for solar technology. Silver is also used in other advanced industrial applications, so the silver market is connected to economic growth in a way that gold is not. If global manufacturing expands, then silver demand can rise. If technology investment expands, then silver demand can rise. If solar deployment expands, then silver demand can rise, and if investment demand rises at the same time, then the pressure on available supply can become even stronger. That is the part of the story many casual investors miss. They see silver as simply a cheaper version of gold. It is not. Silver has its own supply and demand structure. Silver can behave like a monetary metal. Silver can behave like an industrial commodity. That combination can create explosive price movements. This is why owning silver requires a different mindset from owning gold. Gold often behaves like financial insurance. Silver can behave like financial insurance with an industrial engine attached to it. That engine can accelerate the price when demand becomes strong, but it can also create weakness when economic expectations deteriorate. This is why the next major economic signal could matter enormously. If traders start expecting weaker growth and easier monetary policy, then gold could gain from safe haven demand and lower yield expectations. Silver could gain from monetary demand. But silver could also face pressure if investors become worried about industrial demand. This creates two competing forces, and the market is currently trying to decide which force will win. There is another reason you should pay attention to tomorrow. Markets often move before the headline becomes obvious. Institutional investors do not wait for everyone to understand a trend. They position before the crowd. That means price action can sometimes send a signal before financial news catches up. If gold holds firm while the dollar remains strong, then that can be an interesting signal. It can suggest that underlying demand remains powerful. If silver continues to hold elevated levels despite short-term selling pressure, then that can also be significant. It means buyers may still be willing to step in during weakness. That is what you want to watch. Do buyers appear when prices fall, or does every bounce attract more sellers? That difference can tell you much more than a dramatic headline. Now let's talk about the biggest mistake investors can make right now. Chasing the market. When gold and silver are moving quickly, it is easy to become emotional. You see a big green candle. You see people talking about a huge price target. You see social media posts predicting that silver will explode. Then you feel like you are late. That emotion can cause investors to buy at the worst possible moment. A strong precious metals market does not mean every price is a good entry. A bullish long-term thesis does not eliminate short-term volatility. Gold can fall even during a long-term bull market. Silver can fall much harder. That is normal. The goal is not to predict every daily move. The goal is to understand the forces behind the market. This is where gold investors need to think differently. Ask yourself why you own gold. If you own gold as a long-term store of value, then a short-term decline may not change your thesis. If you are trading gold for short-term profits, then your risk management becomes much more important. The same applies to silver. If you believe silver has a long-term supply problem, then you need to understand that the market can still experience brutal corrections. A bull market does not move in a straight line. It moves through advances. It moves through corrections. It moves through periods of fear. It moves through periods of extreme optimism. The investors who survive those cycles are usually the ones who understand their time horizon. Now consider the geopolitical environment. The Federal Reserve has specifically referenced uncertainty linked to conflict in the Middle East. Federal Reserve. Geopolitical risk can change quickly. A sudden escalation can push investors towards safe haven assets. Gold is one of the first assets many investors think about during geopolitical stress. Silver can also benefit. But there is an important difference. Gold tends to receive the strongest direct safe haven response. Silver can experience a more complicated reaction because industrial demand matters. If geopolitical stress damages global growth, then silver can initially face pressure. If geopolitical stress creates inflation through energy markets, then both metals can benefit. That is why geopolitical headlines alone are not enough. You have to understand the economic transmission mechanism Ask what happens to oil. Ask what happens to inflation. Ask what happens to treasury yields. Ask what happens to the dollar. Then ask what happens to gold and silver. That is the professional way to look at it. Now let's talk about central banks. Central bank demand has become one of the most important themes in the gold market. Central banks have reasons to diversify reserves. Gold has no corporate issuer. Gold has no credit risk in the traditional sense. Gold is not another country's promise to pay. That makes it attractive as a reserve asset. When central banks increase their gold holdings, it can create a structural source of demand. This does not mean gold must rise every day. It does mean the market can have a deeper long-term demand foundation. Silver does not have the same central bank demand structure. That is another major difference between the two metals. Silver's strength comes from a broader combination of investment demand and industrial demand. This is why silver can sometimes lag gold for a while. Then suddenly silver catches up. When that happens, the move can be extremely fast. Investors often call this a catch-up trade. Gold moves first, silver follows. Then silver begins outperforming. That can attract momentum traders. Momentum traders can attract more buyers. More buyers can push prices higher. That can create a feedback loop. But feedback loops work in both directions. When momentum breaks, the selling can also become aggressive. So if you own silver, you need to be prepared for larger daily swings than you might see in gold. Now look at the broader market. Recent precious metals trading has shown gold and silver remaining elevated while the dollar and treasury yields continue to influence price action, mint. That combination is important. If yields rise sharply, then precious metals can face pressure. If yields fall, then the environment can become more supportive. If the dollar rises, then metals can face another headwind. If the dollar weakens, then metals can receive support. This is why the next session should not be judged only by whether gold closes higher. You should watch how gold behaves relative to the dollar. You should watch how silver behaves relative to gold. You should watch whether silver is outperforming. You should watch whether buyers defend important technical levels. And you should watch whether the market reacts positively or negatively to economic data. That is the real information. There is another factor that could become increasingly important. Market expectations. The Federal Reserve does not control markets directly. It influences expectations. If traders believe rates will remain high for longer, then yields can rise. If traders believe cuts are coming, then yields can fall. Precious metals respond to those expectations before the Fed actually moves. That is why a Fed meeting is not the only important event. Every inflation report matters. Every employment report matters. Every major economic surprise matters. Every speech from a Fed official can matter, and every major shift in bond market expectations can matter. This is why gold and silver investors need to think like macro investors. You do not need to become an economist, you just need to understand the connections. Higher inflation can support precious metals. Higher real yields can pressure precious metals. A weaker dollar can support precious metals. A stronger dollar can pressure precious metals. Geopolitical risk can support safe haven demand. Weak industrial growth can pressure silver. Strong industrial demand can support silver. Central bank buying can support gold. These relationships are not perfect. Markets are never that simple, but they provide a framework, and a framework is much more valuable than a prediction. So what should you watch before tomorrow? First, watch the dollar. If the dollar starts falling while gold and silver remain strong, that can be an important bullish combination. Second, watch treasury yields. If yields decline while gold holds firm, then investors may be pricing in easier monetary policy. Third, watch silver relative to gold. If silver begins outperforming gold, then risk appetite inside the precious metals sector may be increasing. Fourth, watch volume. A breakout supported by strong participation is generally more meaningful than a move on weak activity. Fifth, watch the reaction to economic data. The market does not care only about whether data is good or bad. It cares whether the data is better or worse than expectations. That distinction is critical. A strong economic report can sometimes hurt gold because traders expect higher rates. A weak economic report can sometimes help gold because traders expect lower rates. But if weak economic data creates a major recession fear, then silver can react differently because of its industrial exposure. This is why silver is such a fascinating asset. It sits between two worlds. It is a monetary metal. It is also an industrial metal. That dual identity is what makes the upside exciting. It is also what makes risk management essential. Now let's discuss the biggest question. Could gold and silver continue higher from here? The answer is yes. But nobody can guarantee the timing. The bullish case is easy to understand. If inflation remains elevated, then demand for hard assets can remain strong. If interest rates eventually move lower, then precious metals can receive additional support. If the dollar weakens, then metals can benefit. If geopolitical uncertainty remains elevated, then safe haven demand can remain strong. If central bank gold demand stays healthy, then gold has another structural source of support. And if silver industrial demand continues growing while supply remains constrained, then silver could have an especially powerful setup. But there is also a bearish scenario. If the dollar strengthens sharply, then metals could fall. If treasury yields rise, then investors may rotate toward yield-producing assets. If inflation falls faster than expected, then the need for inflation protection could decline. If economic growth weakens significantly, then silver could face industrial demand concerns, and if speculative positioning becomes excessive, then a correction could happen even inside a long-term bullish market. That is the reality investors need to accept. Bullish does not mean guaranteed. Bearish does not mean permanent. Markets move through cycles. The most important question is whether the underlying trend survives the correction. That is why you should not panic over every red day. You also should not become reckless during every green day. Stay focused on the larger picture. Gold and silver are now major parts of the global macro conversation. They are no longer assets that only a small group of investors watches. Gold is being watched by central banks. Gold is being watched by institutional investors. Silver is being watched by industrial companies. Silver is being watched by commodity traders. And both metals are being watched by investors who are concerned about inflation and currency risk. That creates a very different market environment from the past. The next stage of this precious metal cycle could be defined by one simple question. How much physical demand exists behind the paper price? If investment demand continues increasing, then the market can become tighter. If industrial demand remains strong, then silver can become even more sensitive to supply conditions. If gold continues attracting reserve demand, then its long-term foundation can remain strong. But investors should remember that paper markets can move much faster than physical markets. Futures contracts can create sudden price swings. Leverage can magnify those swings. That means a short-term price drop does not automatically mean the long-term story has changed. This is especially important for silver. Silver is famous for violent moves. It can spend weeks moving sideways, then it can move sharply in a short period. That is why patience can be an advantage. If you own physical metals, then your strategy may be very different from someone trading futures. Know which game you are playing. Know your risk. Know your time horizon. And never let a headline make your investment decision for you. The market will always give you another opportunity. The goal is not to catch every move. The goal is to stay positioned intelligently. So as we head into the next trading session, I want you to watch one thing above everything else. Watch the relationship between price and pressure. If gold faces selling but buyers quickly return, then demand may still be strong. If silver drops but buyers defend the decline, then that can be constructive. If both metals break important levels and fail to recover, then caution becomes more important. The reaction tells the story. The headline tells you what happened. The reaction tells you what the market believes. That distinction can make all the difference. And remember what the Federal Reserve is telling the market. Rates remain restrictive. Inflation remains above the 2% objective. Economic activity remains solid. The Fed is watching incoming data closely. Federal Reserve. That means the path forward is not guaranteed. It also means volatility can remain high. For gold and silver investors, this is not necessarily a bad thing. Volatility creates opportunity, but volatility also punishes emotional decisions. So before tomorrow, ask yourself one simple question. Do you understand why you own your gold or silver? If the answer is yes, then short-term noise becomes easier to handle. If the answer is no, then this may be the perfect time to step back and rethink your strategy. Gold and silver are not magic. They are not guaranteed profits. They are financial assets with unique characteristics and unique risks. But the current environment gives investors plenty of reasons to keep watching them closely. Inflation is still part of the story. Interest rates are still part of the story. The dollar is still part of the story. Geopolitics is still part of the story, central bank demand remains part of the gold story, industrial demand remains part of the silver story, and expectations about the Federal Reserve may determine how these forces interact. That is why tomorrow matters. Not because we know exactly what will happen. We do not. Tomorrow matters because the market will give us new information. And the smartest investors are not the people who pretend they know the future. They are the people who know how to react when the future becomes clearer. So if you own gold or silver, do not panic. Do not chase. Do not make a decision based on one dramatic headline. Watch the dollar. Watch yields. Watch inflation. Watch the Fed. Watch silver relative to gold. And most importantly, watch the behavior of buyers and sellers. The precious metals story is still developing. The next major move may already be forming beneath the surface, and if gold continues to hold strong while silver maintains its strength, then we could be looking at another important phase of this market. But if momentum breaks, then a correction could come first. Either way, the opportunity is to stay informed. This is exactly why we follow these markets every day here on Silver and Gold Watch. If you found this analysis useful, then make sure you like this video and subscribe to the channel, and I want to hear from you. Do you think gold and silver are preparing for another major move, or do you think a correction is coming before the next rally? Tell me your gold price target and your silver price target in the comments. Your opinion could become the starting point for our next market discussion. And remember that this video is for education and information only. It is not personal financial advice. Always consider your own risk tolerance and financial situation before making an investment decision. For now, keep your eyes on the market, keep your emotions under control, and keep watching the signals that matter. Because in precious metals, the biggest move often begins before the majority of investors realize what is happening.